Welcome back again. We're going to continue on with company law area. We've got one area left to cover, and that's directors' duties. So we have two diagrams here. Directors' duties, and we have the worksheet on directors' duties and suing directors. So if we start just going through the diagram on directors' duties. Now the diagram initially looks a bit complicated, but it actually only has two major steps to it. One is decide who is a director, and then decide what can they be sued for. Now, those are the director questions there. So we have three types of persons can be director, and then we have the duties that apply to those people from the Companies Act. Now you note the sections 131 to 141 come in both of these areas, and so we'll focus on those a wee bit. But we've also got these sections here, 145 to 149, which relates to directors disclosing self-interested transactions. So our start point is, who's a director? Now that's clearly covered in the Companies Act in directors and their powers and duties, and we've talked about this previously, the meaning of director. So we had three people who could be considered a director: a person occupying the position, so our nominated directors, or a person called a director in the company. And then we have the so-called deemed directors. A deemed director arises in these three circumstances: a person in accordance with whom directions or instructions of a person referred to in paragraph A may be required or accustomed to act. And the second one is the same thing, except it says the board may be required or accustomed to act. So the board is the combined directors. So let's say we have a family business and the parents are handing over control to the children, and so they resign as directors and the children become the nominated directors and are on the company's register. However, the parents continue to take a very active role in the business, attend all directors' meetings, and effectively deal with creditors and make the directors' decisions. They would be very likely considered to be a director under section 126(1)(b), in that the actual directors, the children, are accustomed or even required to act under their instructions. The third one down here is the reference to shareholders who have controls under the Constitution that would normally go to directors, and we've talked about this previously, and there's an examples in a previous video. Those people are going to be directors as well, and that's the risk of taking power off the directors and giving them to yourselves as shareholders. But it's a commercial decision. Is it worth it? Now, in that diagram, it then goes through to say, well, what are the actual liabilities and duties of these people? And we work through those sections. Now, just to mention something first, though, we'll come back to that, is when do we actually sue the directors? Well, predominantly directors are sued in a liquidation, by which time it's too late to save the company, so we're talking about suing directors to get money to help pay creditors. However, while a company is in trading, you can take actions, one of which will be section 164, which is an injunction order to stop. So if you're a minority director of a company and you don't like what's happening and you believe the directors are breaching the Companies Act, you can seek an injunction to have the court order them to stop the action. The biggest problem with things during the company's trading is having enough information to know there's a breach, which is why having a director on the board is very useful, or potentially having access to company documents via a requirement in the Constitution. Derivative actions are simply where a person, being, for example, a director, goes to the court and says the other directors will not take action against another company, or I'd like the company to take action against the other directors. Now clearly, if you're one director out of three, you're not going to convince the other two directors to have the company sue them. But you can go to the court and ask the court to grant you permission to sue the other directors in the name of the company. This is a derivative action, and this will be supervised by the court. In that situation, the company will pay for the action and the company will receive any money that flows from it. Shareholders do have some limited rights to sue directors, but have a look at these sections. You'll note they really relate to simple things like the shareholders register. They are not strong powers during trading. So the predominant issues arise in liquidation, and we have two major sections. Section 300, which relates to the requirement to keep accounts, and 301, which brings in breaches of all other sections. So let's go to those two sections. Now, starting with section 300, so we wind our way through the Companies Act. Okay, and this relates to liability for not keeping proper accounting records. See, a company that is in liquidation, so it must be in liquidation, and unable to pay all its debts, has failed to comply with Section 194, which is the obligation to keep accounting records, or if you're a reporting entity, keeping the correct types of records. And the failure to have accounting records has contributed to the company's inability to pay its debts. So if you don't have accounting records and you don't know what your cash flow is, you do have a major problem in making justifiable decisions. And you possibly would not have contracted certain debts if you had the accounting systems in place, which would have made you realize there was a problem. Equally, some companies have had problems in collecting debts because they have inadequate records on their debtors and what has and has not been paid. So if that has been a part of the cause of failure or has created uncertainty as to the company's assets and liabilities, and incomplete accounting records would often do that, or has impeded the orderly liquidation. Often in a liquidation, the liquidator, and the same in a receivership, will find that the accounting records are such that they need to be reconstructed and often trace back to source documents, and if there's no source documents actually found, which makes a lot of work and often results in inadequate evidence to take further procedures. So that impedes the liquidation. Or for any other reason that the court thinks appropriate, the court may, on application of the liquidator, so this is the liquidator brings it, declare that one or more directors or former directors are personally responsible without limitation of liability. So this pierces the corporate veil and makes the directors personally liable. And this all relates to accounting records. Now, the basic requirement for accounting records is that you have records that correctly record the transactions of the company, so those are your source documents, and enable that the financial statements or group financial statements will comply with accepted accounting practice. Now note in brackets, if the company is required to prepare such statements under this Act or any other enactment. So small companies often do not need to prepare full financial accounts. So the question is, what is acceptable for that company to comply with Section 194? And that really comes back to, well, what have you got in the way of accounting systems that allow you to make proper decisions? So things like profit and loss balance sheet tend to be end of year statements of performance. They're retrospective, whereas budgets and cash flows, source and application of funds, and simply proper cash flow management are the type of accounting records and processes that will help you not breach the Companies Act. Okay, now going back to where we were, the other section that's very important here is Section 301. Now, Section 301 does not actually say when you can sue a director. It simply says that if it appears the court that a person has taken part in formation, promotion, and past directors, managers, administrators, liquidators of the company, so that's pretty much anybody involved in a relatively senior role in the company, has misapplied or retained, so that's misuse of funds or retentions, or guilty of negligence, a default, so that would be a breach of any of the sections of the Act or other acts, or a breach of a duty or trust, so that's fiduciary duties in relation to the company. The court may, on application of a liquidator or a creditor or shareholder, so note once again, this is in liquidation, on the application of liquidator, creditor or shareholder, inquire and order that person to pay or restore money or property and contribute such sums as the court thinks just. So this is another unlimited liability of directors if they are in breach of their duties as directors, in breach of the Constitution, or in breach of any other fiduciary duties. Now, what that leads us to is considering, well, what duties can they breach under this Act that we could sue them for? And the ones we predominantly look at here are the duties of directors under Section 130 to 137. Oh, back. You can see there's a lot of them. So under this heading, directors' duties, and we have a list of duties which we'll work through in the worksheet. Now, if you notice the structure of this, we have a set of duties, and the ones we focus on are 135, 136, and then we have a defense of use of information and advice, where if a director has relied on a professional advisor or competent employee to make a decision, this will create a defense if the director is sued. So we'll stop here and we'll come back to the worksheet and address those issues there.